Alright, ladies and gentlemen, welcome back to another video. Today is going to be another podcast style video, as per usual. These are the kinds of videos that I want to make. And sure, they might not get the most clicks, the most views, but I think they're far more impactful than any other type of video. So today we're going to be discussing the idea of predicting the markets and how new traders often fall into this trap of trying to predict the outcome of each trade. Now, very often the way that this is done, especially with educators and mentors nowadays, is they add more confluence points, they add more technical parameters to quote unquote increase the probability of a trade playing out. Now, in my eyes, this is almost always a false narrative. So people are so caught up in the outcome of each individual trade that they are grasping onto anything that can create certainty, right? And it's very, very natural, very normal for us as humans to want or yearn for that certainty, when the unfortunate reality is that trading is an uncertain business. It's an uncertain market. We cannot know with any level of certainty what's going to happen next. And the sooner you realize that, the sooner you can actually start to make progress. Most beginners fall into this trap of trying to predict and forecasting the future. They're trying to know where the market's going to go next because they think if you know where the market's going to go next, that's how you make money, right? When that's not the case, right? Trading is a game of probabilities. Markets are probabilistic, not deterministic, right? So even the best setups, even the best trades can lose. When you introduce this aspect of prediction and trying to predict what's going to happen next, you very easily introduce ego, bias, and emotional trading into the way that you do things. And very often this is just a recipe for disaster, a recipe for going round in circles and never really making any levels of progress in your journey. So when you focus so much on the outcome of each individual trade and trying to be right, you get attached to being right as opposed to executing correctly. So you're so focused on trying to win that you take away from actually the process that is consistency. The shift that you need to make is going from prediction to probability. When you stop trying to predict, you focus on process over outcome. And what does that mean? Probability, thinking in terms of probability means you accept uncertainty. You accept that you don't know what's going to happen next, and you don't need to know what's going to happen next. And that's when trading starts to become predictable. Once you stop trying to predict, your results become consistent and predictable. You eliminate that emotional interference with trying to be right and wrong, so focused on being right, and you become focused on just following your system as best to your ability. When your process is consistent, your outcomes become statistically reliable. And when you can consistently execute an edge over time, you can predictively predict the outcome of that sample of trades. So you have to shift this mindset of, I know what's going to happen next. And you have to shift it from, I don't know what's going to happen next, but I know what I'm going to do next. Right? And so the randomness of the market starts becoming manageable because it's not about the outcome, it's about your personal outcomes of what you do in each scenario. At the end of the day, the market doesn't reward intelligence. It doesn't reward how smart or how technically complex your analysis is. It rewards how consistent you are. How consistent are you with following a clear set of rules with a statistical edge? That is what matters in this game. Once you stop trying to predict the outcome of each individual trade, the outcome of your results becomes predictable.